Good evening. Welcome to welcome to episode 67 of Business News. My name is BindiBindi. Mike.
Good evening. My name is True007.
Yep, and mine is Jesse. So here we start. Every day I wake up and I lose money. You know who's saying that now? The middle class. It is true, isn't it? They wake up, whatever money they have in the bank, the purchasing powers just keep dropping. And when Mr. Powell says, when he goes play, fly fishing or play golf, everybody's afraid because they will go like, I think he's going to make up his mind on 75 basis points. Now that's the norm. That's the optics being pushed now. The market has come, or the public has come to accept that, I think we need to get to a certain level. What level, we do not know. The gods know, all right? And because they have accepted that, I think that's given the regulators some push to go, let's go for it. So there's two schools of thoughts. Oh, wow, that's the TED. That's the TED one. That's the TED spread. No, we're not going to talk about TED spread today. That's the past TED spread. But okay, since we're at this. All right, TED spread. Now, TED spread, of course, we know is my favorite. The euro dollar, the LIBOR actually is the London interbank rates, or offered rates. All right, this is what banks will offer to each other or institution offering to each other. That's the if I'm not wrong, that's the green line, and then the blue one, the red one is the TED, and then of course the US T-bills, right? The US T-bills being treasury bonds. Yep, there you go. So the TED represents the spread. So the higher the spread, the basis point, the higher the basis points, the difference. All right, you can see in 2008 July, and then 2008, and you see a spike. You see a spike in the TED spread. There you go. Yep. Some more. Yep. There you go. Yep. So you remember what happens back then, right? The GFC. All right. Okay, you can zoom out. Thank you very much, producer. So the TED spread are telling us something. The euro dollar yield curve, the inversion is telling us something. The T-bills or the treasury bonds are telling us something. Meaning banks are going like, now we think default rate is going to increase. All right. Every time the TED spread goes beyond 48 basis points, it is a clear, a clear indication that inflation is, recession is on the way. It's definitely there. And how far has it gone? It has gone to 150 to 180 points, and then it has gone even as far as 400 or 250 points. That's pretty far, meaning the market is pricing in a lot of volatility. We do not know what's the latest one. We'll bring you the latest again next week, because I think that's the sector we have to watch now. Now we have a bellwether. We have some of the people coming up to say, all right, rate cuts. So meaning Fed will start to cut their rates post after March 2023, and then there's some who goes, no, I think the rate cuts will begin by the end of next year, December 2023. This is an interesting curve. We're not going to talk about that today. All right. So whatever it is, the prediction is recession is 2023 early. All right, from June, perhaps now is March. My personal take, perhaps March. But the thing is, 75 basis points is the norm now. So have you priced that in? Has the market priced it in? Has the market even priced it in for September, which looks likely to be rather hawkish, 75 basis points? And then thereafter, a series of increase. That's what they're saying, to 2.5 to 3% by the end of this year, or even to 3.54% next year. Again, the take is, I think it could be much higher than that, and therefore it doesn't augur well for most of the how people have allocated their portfolios. So time to take stock of that. And it is also interesting that 007 is going to share with us, right, in the backdrop of ever increasing inflation, ever increasing interest rates, and then we have gold price stagnant, going sideways. And over to you, 007.
Thank you, Jesse, for the overall discussion about the the general trend and patterns of a serious depression of the world economy. Okay, what I'm going to want to share with you is we're going to look at a comparison of the interest rates. Okay, of course, against the exchange rates against the US dollars for the major currencies. From that pattern, I think we can argue that the surging dollar will drop next year as the US split into recession and the Fed's cut interest rates. Okay, that is said by Wells Fargo, one of the world's leading investment bankers. Okay, so Flower, please. The slides about the US. Okay, good. US index, US dollar index. So the US dollar index, what I've taken is a monthly chart. So next, the chart on the, yep. So you can see from the right hand side, stay in the chart. Yeah. Yes. Thank you. You see from the bottom, which is indicate the 88.25. That is where the line is. I think it's about nearly 90 points. For the last year and a half, look at the right top corner, gone to almost 110. Okay, 109.29 points. The index shows over the last year and a half. Okay, so 18 months, the US dollars index has gone up to 22 somewhat percent. So say let's 20% to make it simple. Okay. When that goes up, we know that the major currency pairs will goes down. Let's see. Next slides. Flower. Let's see how. Yeah, that is. Keep going. Next one. I can't see the name of it. Okay. Well, the market insiders said the surging dollar will drop next year. Just what Jesse and been discussing that the market rates maybe drop the year after, early 2023. Well, that's next year. So, yes. So, and I mean, we want to see from a comparative purchasing power, which is a comparative exchange rate. We want to see whether this is going to be true or not. So next slide, please. So I'm going to review a few major currency pairs to see the exchange, the rates compared with the US dollar. See, one of the major indicators is US dollar and Japanese yen. Okay, US dollar, Japanese yen, US and Japanese. So you can see over the last, it went up from like 100 points to 139. Well, that's almost 40%. So Japanese dollar has lost its value by 40%. Can you imagine if you live in Japan? What does that make you feel? You feel your Japanese yen, okay, if it's priced by US dollars, you lost 40% of your purchasing power. That's none. Next one, please. Flower. Okay, say let's see what this one. Keep going. So this is euro and US dollars. Okay, euro and US dollars. I mean, it's now less 0.99755 US dollars per euro. I mean, this is never seen before for a long time. So you can see the rate was 1.2553, which is a dollar and 25 US dollars for a euro. Now it's say 1 to 1. So lost 25% value. Okay, the Japanese is 25% and the euro is 25%. Okay, that is the eurozone and the Japanese yen zone. Let's look at the pound. The English pound. English pound now is 1.17. Okay, US dollars for English pound. Let's go have a look at the next chart, how the graph looks like. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So that's the last, let's say, last year from $1.43 US dollars. Now we're going $1.17. So 20. So it's about 20% roughly. Okay, 20%. 20%, 18 to 20% drop of value. Okay, so we see this one. Any more? Well, that's an interesting one. But however, it does fit the same pattern. Okay, offshore RMB against US dollars. Okay, yesterday is 6.8684 yen RMB. Okay, trading for $1 US dollar. Next one. Let's see how long does it take. What happened over the last? Okay, 1, 2, 3, 4, 5, 6, 7, 8, 9. So a year and a half. We see that it actually is from 6.305 yen a dollar. Now get 6.68. So what is the 50? Yeah, so it's about 10%. Okay, well, this might be like a cockroach, very long lasting in June. As Miles Gore said, RMB will be become Joss paper, so it won't gonna worth much. But it's 10%. I think this is manipulated, called the overseas RMB, manipulated by CCP to get the trade balance and make sure that they can continue to money laundering the RMB converted into US dollars and stored on the individual bank account. So at the expenses of the Chinese real economy. Okay, so what is the sum up? What is the sum up? What we can see, US dollar against the major currencies, it dropped. Okay, whether it's pound, euro, Japanese yen. Okay, so it dropped around 20%, 18 to 20% value, and with RMB dropped by 10%. Okay, it's exchange value. Now let's bring everyone together in the same. My question is, if you were the central bank's chairman of the other currencies rather than US dollars, what option do you have if this continues? Number one question. What option do you have? Do you feel you like to decouple from the whole US dollars? Start your own basket trading group, which is make it easier and make sure that your purchasing power, which, purchasing power parity means your national GDP is devaluated by 18 to 20%. And the Chinese national GDP devaluated by 10%. That is artificially manipulated. If not, probably 50% gone, I think. According to Miles Gore, by some end next year, it will be like 50% value will be gone, up to 100%. Okay, so this makes me feel shivering because since Russia and the CCP are now trading together, okay, they become the most needed economy between each other. One, China is supply all the consumable, where China need energy, okay, and Russia just perfect. They already have the pipeline, everything there, and supply the energy then for Russia's for the trade balance. So they can go together with other countries like Middle East, and also Germany and France indicated very clearly they're going to go with the RMB digital currency trading basket, because they need the Russia's energy. There's no way they can survive without Russia's energy. When the Northern Pipe supply cut for 3 days, Germany, France's energy price gone up 9 times in that 3 days in the spot market, okay, spot trading market. So this says something. I mean, every country's currency is working for their own national interest. There's no question about it. When you against the strong US dollars, okay, with the interest rate keep rising up, okay, and that directly added to the world energy prices. So inflation equal to, interest rate up equal to partial inflation directly. There's no middleman in between. Straight away passing from central bank to the all the commercial banks, including the interest rate we're paying for our mortgage, for factories rental, and so on. So for commercial and residential as well. So that's directly counted as your inflation. So what option would you have if you were the central bank of the European countries and also UK, all right, and Xi Jinping? Okay, what will you do? I think I pose the question back to Jesse first. Thank you.
All right, I'll have lunch with a lot of people. I'll have lunch with the credit agencies first. I'll have lunch with the Moody's and the S&P, because which means my borrowing cost is might very likely have to go up significantly. Which then, of course, that's a very good question by you. It's a strong dollar good for us. Now, in the scheme of I've got some numbers here. In the scheme of exporting country, for example, like Australia. Although we are more commodities exporting country, it might augurs well, because I'll look at our Aussie dollars. We have been hovering at the 68, 69 mark, and I had a discussion with someone the other day over copper, and I said, I think perhaps we might just test the 64 level again. Remember I think it was in April or May 2020, we actually dropped to 60 cents to $1. That's devastating. That is like, wow. And I think we are at 1.46 to $1, which is about 68, 69, if I'm not wrong. So then the real question becomes QT, QE. So in one of our program, we say, before the QT really starts, there'll be a few more rounds of QE in specific sectors, which Mr. President Biden has done, releasing cash into the student loans, which I was shocked that it was about 1.3 or 1.6 trillion dollars worth. The next biggest debt bracket, sector after the mortgage loans. And then, of course, if QT was to start, then interest rate cuts. Some of us, like yourself, said, by the end of next year. So interest rate cuts by the end of next year. So if, let's say, we have another 5 rounds to go, another 5 rounds of 7, and don't rule out 1%, 100% points anyway. What would that bring the cost of liquidity up to what level actually? And how many companies will be crushed? Remember, we are coming from 0.1% for mortgage loans. We are standing at what, 2 point something, 2 or 1.85 or 2 now, and we are targeting 3.25. All right. So the amount of stress you will put a lot of companies, you'll put a lot of mortgage holders under, and hopefully, that's the financial side. Hopefully, the economic side that will not hit us at the same time. Negative equity is always something that we want to watch, of course, and then borrowing costs for banks, and therefore borrowing costs for companies. A lot of the SMEs, will they survive? If they don't survive, how many percent will not survive? And one of the largest employers are actually the SMEs, as we know. So that's one sector to watch. And that's a very good question. Now, against the G10 or the EUDs, US dollar against the EUDs, I found it. I've of course, Mr. Moscow has said why they want to do that, and I found it really interesting that the US is a basket of currency, right? 57.6% or 56.7% are actually denominated in EUD, and that is a sharp drop from 1.3, like the Japanese yen, 1.3, and then of course then EUD drops against the US dollar. So perhaps, I'm not quite sure, but perhaps it might be a harbinger for the Plaza Accord. I'm not quite sure. I don't know. I can't wrap my head around that yet. But I'll do a bit of a deep dive. And how does that lead people towards the Plaza? Because the US knows that Mr. Moscow said, the officials have been doing their rounds in Southeast Asia, in the MENA region, MEA region, that is, and obviously to talk to institutional funds and SWFs to buy more of the treasury bonds, which of course they know that the US dollar, the hegemony of US dollar is in question, and they are in doubts. They don't want the contagion to spread, and therefore, while they still have the power, all right, the so-called the trust and the military power, they want to shore up the US dollar first, and that is a big thing. Whether they can do it and how long they can do it, eventually 5 to 10 years, I very much doubt so. And 10 years, I very much doubt so, but 5 years perhaps we still need the US dollar as a global currency reserve. Over to you, Bindi.
Real estate
Bindi.
crash. I've already heard someone saying in church that there's a friend who is going to put his property up for sale because his interest has gone from $800 a month to another $600. So he can't stand it. He's putting his property market on the market. So that is just one example. But generally, how far and wide this will spread and how fast the market will respond, maybe we've already seen it in the East Coast. In the West Coast, probably Perth is slow in coming. Again, what can we do? It's like by the time US dollars slip into recession, I think half the world have been taken out. It's just like for companies, for individual household, you just can't last that long. A year is too long when you're under financial stress. So I want to bring back my co-host and ask them this question that I cannot answer. What can you do? What can countries do? What can other economy do, especially the importing ones, nations which do not have much to sell, like other countries where you have something to trade, perhaps lower exchange rate is okay. But what if you are importing country? I think you're dead in a few 12 months or so. By the time US slip into economy and US starts to lower interest again, companies are dead, enterprises are dead, many countries are taken out. But is that by design? I think to a certain degree, it may be by design. Come, let's bring back True007 and Jesse, and let's have a brainstorm about this in that 5 minutes that we have.
Oh, 5 minutes? Okay. Oh, to cut it short, I guess that everything, once you go, especially it's a zero-sum up game in the platform of world, currency exchanges. Basically, if one, say for example, US dollar, once it goes very high, it must come down to balance up. Otherwise, this whole trading partnership will become like a twisted to a degree, where other countries will have the decoupling from the US dollars, because they just can't afford to have their own currency crashed in terms of the purchasing power. Traditionally go up and down 10%. I think that seems allowed if you look at it. But when you come down 20%, this is far away from the mains. So therefore the risk of decoupling from a strong dollar, the tendency depends on how politically, always a political economy, how comfortable the party is. For example, Germany and France, according to my score, these two countries, they have to depends on Russians oil energies. They cannot survive without the energy pipe supply, or they get buy elsewhere and the price is too high. They're probably going to start a revolution. The people inside there, they already think about not paying the high price. Everyone is not going to pay the gas bill, for example. So the energy bills in Germany and France. When that happens, I think a country has to consider its own stability. I.e., I think they will go with the proposal China and the Russian have, to join the China-Russian digital currency trading zone, and then to decouple or partially decouple from the US dollars. This is what I can see. But I think Australian, do we have any exception? I don't think so. Because we know that in a couple of months ago that it's already in the news that China and Australia are already trading. China is buying the Australian iron ore and the coal, coking coal and energy coal for what? For using the Chinese currencies. We already swapped the Australian dollar with the RMB at a pre-agreed fixed rate. We're just trading in that way. It's already happening. I mean, despite the Five Eyes, concept, but as Miles Gore said, they remain just a concept. Okay, it's a political slogan. In real business, in real trade, and it is what it is really the best for interest for the nation. I think both nations find they need each other. So I think that might be saying a third country will decouple from the US dollars, perhaps. But I think probably remain 50-50 because otherwise it'd be too much. But what about the English UK, UK pounds? But I think that there might be a risk too. Okay, so I mean the euro. I think definitely the way it goes, it devalued so much, and we could see the fall of the eurozone once Germany and France, which are the two the highest GDP weighted in the European economy, if they're gonna decouple from the US dollars and they go with join the RMB and the Russian digital currency together, so we might see a split of the world economy. But however, if that ever happened, it is not in the best interest of US. Okay, because once that happened, it will never return back again. So once it decoupled, it's very hard to come together again. So I think the US, that's why my proposal tonight is the US Fed is going to stop increase the interest rate by the end of March, so the first quarter of next year. They can't go in the end of the next year because that is too long and no one can sustain in terms of household inflation, as well as then the purchasing power of parity. And the country will lose too much of its economical GDP weights. So that will affect the credit rating as well, when Moody comes around. So that's all the tools the US have to stress the trading partners. So my proposal, is that most likely US Fed will go bullish until the midterm election finished. So by Christmas time, they might make a statement to say, "Hey, Christmas gift. Okay, we're going to continue increase rate for 3 months, but by the end of the March, we're going to, come down." So in that way, what happened is, then the whole sentiment is going to become positive for the new government, whatever is elected. This remain unsure whether it's Trump or what is Biden. We're not very sure. So there's so many uncertainties. But what we can see in terms of the United States political sentiment, I think the country might be relaxed a bit. However, we don't forget about the vaccine disaster, which we haven't discussed yet. So back to you, Bindi.
Okay, unfortunately, I want to say something, but time is up. 6:30, 6:31. So, Jesse, do you have something more important than me? You want to talk about?
Go on. You say it. You have the last say. Go on.
I have the last say. What I want to say is just very general. Federal Reserve. Federal Reserve is about maximizing employment, stable prices, and moderate long-term interest rates. Everything is about protecting its own interests. At the end of the day, it also, I think, Federal Reserve also has the long-term interest of perhaps protecting the interests of the globalists. But whatever it is always about United States first. Taking out the competition may be what they are aiming. It could have a backslash, but maybe that's why USDC is going to come to rescue. The extent and the magnitude of which is yet to be seen, but I don't think the US is that foolish to put itself at the end of the rope. Even with all the other countries coming together with a different basket of currencies, something will bound to happen. Could it be a hot war? We don't know. Something will bound to happen. They will turn the game around. Jesse, let's wrap it up.
All right. So what is not in the narrative, public narrative, is the length of decline. I think we will begin to hear that the public narrative pushed out by the central banks and the powers that be are going to say that, oh, you know what, this is going to be a protracted one. So the decline will be long, 3 to 5, and then perhaps to 8 years. But if they come out now to say, even if it's 2 years, a lot of people will not be able to accept that, because we are used to the V-shaped rebound, and we are still holding on to a V-shaped rebound. Gold has been very silent, and that's a worrying sign. I mean, something is brewing there, which we are not seeing because it's not behaving the way it should in this context. You know, exported inflations usually via currency devaluation is already happening. Thereafter will be currency war. Thereafter will be trade war, and like you said, maybe kinetic. Who knows? But stay in touch, and I think we will find out more. That's all for me.
Thank you,
Good
everyone, and I hope you enjoy the program, and good night. See you next week.
Very good question, you. Very good question.